Hi everyone, it's Cole Braithwaite, your commercial real estate investment sales expert, coming to you again with another video here. Wanted to share with you the Q3 of GTA commercial real estate market activity as it relates specifically with retail and industrial sales over the last quarter or last 90 days, and kind of give you an idea where the trends and where we see things going forward, how we're going to end off this year, and what it's going to look like for 2023. Also, what I want to quickly share with you in this video, I've been getting a lot of comments and questions from my clients as it relates around valuations, cap rates, interest rates, where property values are going to go in the future, where do I see things trending. And I wanted to take an historical approach here and kind of compare some of the data for you so that you can have a better idea of where we can anticipate how the trend may work out in the future. So want to jump into this one with you and take you through some of the numbers. So first off here, we see the retail market sales for the last quarter. Saw about 15 transactions completed. That's down 59% from last year. That's a total of $336 million worth of dollar volume or sales volume. Again, that's down from last year, about, again, 36%. Now, if we compare this to quarter over quarter over Q1 and Q2, what we're finding is that the trend is similar the same. Sales overall and activity overall is down from last year. Last year was a record year in terms of the number of activities, both retail and industrial, as we'll see. But what we're finding is that we're coming to a common trend of about $300 million worth of transactions per quarter for the retail assets specifically. Now, these take into account buildings over 10,000 square feet. So I'm trying to look at some of the larger properties per se and get some of the smaller outliers out. If we take a look at the industrial market, we saw 79 transactions completed in Q3. That's roughly about $800 million worth of transactions, which is on trend to what we saw in previous quarters. That again is down from last year. Sales number wise, about 26%, as well as the dollar volume again at 28%. So activity is down. What I find for both of what I can attribute a lot of this reduction in the amount of sales activity has just been the lack of inventory available. I can speak anecdotally from a lot of buyers, a lot of clients. There's still a lot of appetite to acquire assets. There just isn't much choices out there, and as a result, we're seeing a smaller amount of transactions occurring as a result. So in order to really move things forward, we're going to have to see a lot more inventory come on the market, and through the data, I'll show you where I'm not too sure that that's what we can expect going forward. So a big question that I've been receiving from a lot of clients is really, obviously, we know at the time of recording of this video, a couple days, we're anticipating an interest rate hike from the Bank of Canada. Again, we're anticipating another one towards the end of this year, and it just seems that central banks all over the world are in lockstep to shut down and stop inflation, and the best way to do that in their minds is through increasing interest rates. Now, this has obviously increased the cost of borrowing and debt on mortgages, of what we've been finding on prime rates, on all types of financing, which is anticipated to wreak havoc on the market. But I have a kind of a counterintuitive idea as to what I think may occur going forward based on some historical data. So what I wanted to put together was really what over the last 20 years were the cap rates, and how did it relate to the bank prime rates at that current time, and then what's the delta or difference between those in terms of numbers, and then how can we analyze and take a look at the trend going forward in terms of what we can expect going forward with terms of cap rates. Are they going to increase? Are they going to stay the same? And how interest rates have affected it. So what I did to here, I put together the retail market one, and I have the industrial just below. But if we take a look at retail over the last 20 years, cap rates have been on a steady decline. And obviously, we as investors, you've been in the market, you know that cap rates have decreased. Interest rates, interestingly enough, our prime rates have declined also as well too, and what we're finding is that the delta between the two has decreased. So they've gotten the difference between the cap rate and the interest rate that a purchaser would acquire the property at has shrunk as a result. So what does that really mean if we're seeing the differences become less? And what we're finding is, specifically with retail, is that investors are actually, over the last little period, and if we take a look from 2021 to 2022, they're willing to accept a smaller delta between their cap rate and the interest rate which signifies that they're willing to accept a lower return for the stability of the asset based on the location. Now, this is GTA specific. Each market is going to be different, but within the GTA, what we're finding is that if owners and investors can acquire a good quality asset, they're willing to hold on it just because their confidence in the overall market, the tenancies in there, and willing to accept a lower return to get their capital put to work. And obviously, we've seen over the last several years, there hasn't been much options or available to put their capital to get a return. So commercial real estate has been a top performer long term. So this can signify the trend going forward. But what we can find is, again, what we mentioned, that cap rates have been decreasing. Even with interest rates increasing right now, we haven't seen the numbers, the cap rates increases yet. Now, this is just year to date for Q up till now for the first 3 quarters of the year. And we may anticipate cap rates ticking up a little bit. But what I'm finding that's really dictating a lot of that is the well-capitalized owners. Many owners that I've dealt with, or a lot of clients, they're not in a desperate position to sell because they don't have much debt on their properties. Their debt levels are low. And they're not forced to sell, even though they may be coming up for renewal on some of their mortgages at higher rates. They're not forced to sell their property because they can cover the debt covered ratio based on the tenancy and then the income generated from the properties. So I just don't see. I see there's going to be a disconnect between the bid and the ask between the buyers and sellers. Sellers are going to expect to still achieve their numbers. Buyers are going to have a different opinion on it. But because of the low access to opportunities and low inventories, we may see a reduction in transactions, but I don't think the values are going to decrease. I think if a vendor is not going to be able to achieve their number, then they're just not going to sell their property, and they probably hold on to it a lot longer. Now, I'm sure there's some owners in the market who are forced to sell or have to sell for particular periods, and they may be willing to take a discount, but I just don't see that on a broad scheme going forward, unless we see the underlying tendencies of those businesses struggle and really take a hit on a lot of the net incomes. And I'll address that below. I have an interesting chart about insolvencies over the last of the year to date here, and kind of give you an idea of on industries and the different tendencies that could be an issue going forward. But just based on the data, I don't anticipate that change. So see cap rates staying about the same or a slight tick up depending on the quality and the tenancy mix. What we're also finding is that if owners have zero to no debt on their properties, what's effective to making transactions work in today's market is being willing to take vendor takebacks and give financing to buyers so that they can bridge the gap. The seller achieves their number, the buyer gets a favorable rate, and that essentially marrying the transaction to occur. So that's what we're finding with it. Industrial is similar in the same respects. Again, cap rates and returns have been diminishing over the last 20 years. The deltas have relatively been staying the same at around 2% difference, 2 to 3% difference between what the cap rate is and what the bank prime rate is. But what's interesting over the last several years is that what we found here is that there's actually been an inflection point this year where the cap rate is actually lower than the debt coverage or the prime rate that vendors are getting on their properties. Now, take this anecdotally. A lot of this sales cap rate data is an average of what's happening in the market. This is also what's stated cap rates from what I was able to find. Obviously, at each property, a cap rate's different, but overall, this gives us kind of a general idea of the overall trend and what we can anticipate. What's interesting with industrial specifically is that what we're finding is that even though the transactions may occur with a tenancy in place and there's a cap rate attributed to that, the buyer's intentions may be to occupy it once the lease is expired. So they may be looking at it completely different than an investor would on an income perspective, but looking at it on a price per square foot, where I'm going to operate my business in this property once this tenant leaves. So the cap rate that I pay may not matter as much, even though it's registered or it's logged in, at that number. So I find, again, industrial specifically, low levels of inventory, high construction costs and land costs in terms of building newer product. So it's a constrained market. I don't see there's going to be a lot more supply that's going to push that up, and I can see values continuing to trend the same and increasing as well. And cap rate returns are just going to be lower. What we're going to find with industrial specifically is that owners are just going to have to come up with more, or buyers are going to have to come up with more capital to make the debt coverage service ratios work, and And it's going to be individuals that are well capitalized with a long-term perspective that are going to be the ones that are going to be doing the deals going forward as it relates to that. So it gives you kind of an idea on it going forward. What I have here are some of the notable transactions for the last quarter, so you can take a look through these in the attachment so that you can see some of the notable sales for industrial and retail. But what I want to take you to the last slide here is relating to the insolvency data for this year, specifically on our year-to-date transactions that have or businesses that have gone into bankruptcies and the specific industries. Right now, what we've seen is about 154 companies that have gone into bankruptcy, and they're broken down by industry. What I'll highlight is a couple ones that are notable to me. And the reason why I bring this up, if you take a look at the tenants in your properties and the industries that they are reflected, whether they're providing goods and services to, you can anticipate if, let's say, a particular industry is having a higher than normal number of bankruptcies in a current given year, you can anticipate maybe there could be some challenges going forward for your property or for your tenancy going mixed if it's a broad range across industries. What's interesting, first off, is the real estate sector on it. 30 Canada-wide bankruptcies occurred, 17 of which were in Ontario. Now, what's interesting about this is that majority of the bankruptcies that have occurred here were dealing with residential development projects or commercial development projects, and less on income-generating property that was failed to service their debts or to cover their loan obligations. Many of this has been dictated by high construction costs, slowing sales activity, higher interest rate payments that have made a lot of the projects no longer feasible, and as a result, that's why we're seeing a lot in the real estate sector, specifically manufacturing. Again, 17 bankruptcies or insolvencies that are being worked through currently right now, 11 of which are in Ontario. Food and accommodation, again, a low number. This is Canada-wide. There's 7 of which are in Ontario, and they depend on different types of restaurants or businesses that have been struggling. So this kind of gives you an overall idea. This 154 number is down from what was last year previously, and even from the pandemic. So we're seeing a slowdown with it, and it's just not translating over. Now, again, the key indicator with a lot of this data is that it is a lagging indicator, meaning that a lot of the information that we're seeing is past looking. It's difficult to anticipate what we're going to see going forward if there's going to be a rush or increase of bankruptcies, and this is something that I'm going to be tracking and giving you guys the information on, as well as same thing with the cap rates and valuations and pricing, so that you are aware of what's going to happen in the future and how you can anticipate to make better decisions. Just give you an idea of what a lot of owners and investors have been saying to me is that there's many individuals that are waiting to see once interest rates stop increasing so that they can make better decisions going forward. Though on the opposite end, there are still a lot of active investors looking to acquire, individuals looking to sell because they have to, and they're still active in the market today. So it's going to be interesting how we're going to see 2023 shape out, and my job is to keep you guys up to date with information so that you can make the best decisions. And if there's any questions as it relates specifically to your properties, or you want me to dive in a little bit deeper as it relates to your particular situation, I'm always available for a conversation, a call, and we can put together analysis so that you have all the information at hand. But that's the video for today, guys. I just wanted to share the information. If there's any questions, you can reach out to me. And until next time, take care.